Hello everyone, welcome back to my channel Sia Amit Parekh. Today I will be sharing my views on house property income, definition of house property, etc. It will be especially helpful for students who want to know the calculations involved in house property computation. So let's get started. First, let us see the topics to be covered. That is taxability of income from house property, what all income is taxable, then meaning definition of house property under the Income Tax Act, subletting of property, composite rent treatment, that is if we are getting rent for the flat as well as furniture within the flat, then what is taxable under house property and how it is calculated. Then computation of income from house property, which involves gross annual value of let out property, the deductions or expenses which are allowed from that, and the final net taxable value, net annual value, which is taxable income from house property. Also, there is a concept of deemed owner in house property income. That is, sometimes the actual owner is not chargeable to tax for the income received from property, but the deemed owner is chargeable to tax. We'll see there are around five conditions in which which makes a owner as deemed owner, person as deemed owner. We'll see that also. Taxability of income under house property. When we own a house property, we can receive income in two ways. First, when we sell the property and receive money. In this case, the proceeds which we received is taxable as capital gains under the chapter income from capital gains. Second way of receiving income is by letting it out. We receive rent every month. So when we receive rent every month, that income is taxable under this chapter, that is income from house property. So first we need to understand the meaning of house property, how it is defined under the Income Tax Act. It says building or land apportionment thereto. So income, it covers any type of building, that is flat or shop, because building also includes shop. So shop is also covered as house property for the sake of this chapter. Or land apportionment thereto. Land apportionment thereto means that land which is adjacent to the building or the shop. So if there is rent received from only a piece of land, then the rent which is received is not covered as income from house property. It will be taxable either as other sources or income from business or profession. Also, ownership is necessary for income to be taxed under this chapter. So if someone is receiving income for subletting of the property, that is, he is not the owner, he is a tenant and he is subletting it to someone, then that will be taxable under other sources and not this head. The next point is, if we are receiving composite rent, that is rent for a flat as well as the furniture within the flat, then how is it taxable? Composite rent, there are two cases, two circumstances. Firstly, when the composite rent is inseparable, that is, we are not able to separate the rent charged for the flat and rent charged for the furniture separately. For example, if the equipped theater is given on rent, then in that case we are not able to separate what is the charges for the fixtures and what is the charges for the theater as a hall. So in that case, the income is taxed under business or profession or income from other sources depending on circumstances. However, there may be a case when it is possible to separate the rent received for property and rent received for furniture fixture. In that case, only the rent which is attributable to the property or flat is chargeable under income from house property. The rent received for furniture is taxable under other sources or business profession income. There can also be case of composite rent received for flat as well as services like watchman services, lift services, etc. In that case also, if the rent is separable, it is possible to separate the two, then rent for services will be charged under income from other sources. The rent from property will be charged for under house property income. Now let us see the computation of house property. Gross annual value is defined as the higher of reasonable let out value or the actual rent. Reasonable let out value is higher of municipal value and fair rent but subject to standard rent. Now, municipal value is defined as the value which is adopted by the local municipal authorities for charging municipal taxes. Fair rent is the reasonable rent which is expected to be received from the similar shops or flats in the same area. And standard rent has been defined as the maximum rent which a owner is allowed to charge as per the Rent Control Act. So now let us see an example for this first. If the municipal value is 2 lakh rupees, fair rent is 2 lakh 50,000. And the higher of the two, that is reasonable let out will be 2 lakh 50,000. But then if standard rent is only 1 lakh 80,000, then the lower of the two, that is 1 lakh 80,000 will be the reasonable let out value which will be taken. Next we'll see actual rent. Actual rent is very simple. It is the actual rent received by the owner from the tenant or receivable by the owner. So if there is some unrealized rent, that is bad debts made by the tenant, then that is allowed to be deducted from the rent received. But that is also deduction is allowed from the actual rent subject to certain conditions. There are around three conditions. First is that the tenancy should be bona fide. That is, proper agreement must have been made for tenancy, registered agreement or notarized agreement. Second is property has already been vacated by the tenant, and any other property of the same owner is not occupied by the tenant. And last, proper reasonable steps to recover the amount, including which may include legal proceedings, have been taken by the owner. So if these conditions are satisfied, then unrealized rent can be deducted. There may be a situation that a property is vacant for a part of the period during the year. In that case, loss due to vacancy is allowed to be reduced from the actual rent. Only if the actual rent is lower than the reasonable let out value just because of loss due to vacancy. We'll take an example for this also. In the previous example, the standard rent, that is reasonable rent, came to 1 lakh 80,000. Now suppose the actual rent is 2 lakh, but because of vacancy he has received only 1 lakh 70,000. So actual rent in itself is higher than the standard rent, that's the reasonable rent. But because of vacancy, it has come down to 1 lakh 70,000, and 1 lakh 70,000 is less than 1 lakh 80,000. So the actual rent is less than the reasonable rent because just because of vacancy. In this case, the actual rent will be taken as 1 lakh 70,000, and the gross annual value will also be taken as 1 lakh 70,000. Now let us see the expenses which can be deducted to arrive at the final taxable income from house property. These are the municipal taxes paid by the owner. Here we need to note that only if the municipal taxes is paid and paid by the owner himself, then only it is allowed as deduction. If it is paid by the tenant, it will not be allowed. Plus, municipal taxes incurred but not paid will also not be allowed. After deducting municipal tax, we get the net annual value, and there is a flat 30% deduction allowed from net annual value. This is towards all the types of different types of expenses which the owner may incur in respect of the property. So flat 30% of NAV is allowed as deduction. Apart from this flat 30%, one expense is allowed as deduction, that is interest on loan taken for the property, purchase of the property either or for construction of the property. So this interest on loan is allowed unlimited to create a loss if the property is let out. However, if the property is self-occupied, then interest on loan is allowed only to the extent of 2 lakh rupees. So interest on loan is also allowed. And for this, to claim this interest on loan, we need to have a certificate from the financial institution which shows how much interest has been paid by us towards the property, loan on property. First is transfer without adequate consideration to his or her spouse or his or her minor child. Minor child does not include minor married daughter. So this some people may do tax planning, that assuming that the income from the property will be taxable, rent will be taxable in the hands of the spouse who is in the lower steps tax bracket by just transferring the flat to them for inadequate or no consideration. So in this case, that transfer will be disregarded and the property income will be taxable in the hands of the transferor who was the original owner of the flat or property. Second case is holder of impartible estate is deemed as the owner. We need to understand what is impartible estate. Impartible estate is the estate which is not legally divisible. For example, if HUF is the owner of a estate, but then some types of estate cannot be easily divided amongst the HUF members. In that case, the elder member of the family is considered as the holder of the estate which is impartible. So in this case, the taxability of the income received from that impartible estate will be in the hands of the third case is member of a cooperative society or a company or association of persons to whom a building is allotted or leased under a house building scheme of the society. In this case, even though the society or company is the legal owner, the member is considered as the owner for taxability of income. Fourth case, a person acquiring property by satisfying the conditions of Section 53A of the Transfer of Property Act. Thus, conditions are: the agreement for purchase should be in writing, the purchase consideration is paid or the purchaser is willing to pay it. The purchaser has taken the possession of the property in pursuance of the agreement. So, if all these three conditions are satisfied, then the purchaser will be considered as the owner even if the property is not registered in his name. The last one, lease of property for a period not less than 12 years. So it is a very long-term lease. In this case, the lessee is considered as the deemed owner of the property and the income is taxed in his hands.